Aya Gold and Silver Inc. has established itself as a pure-play silver producer with a concentrated and high-growth operational footprint in Morocco. The core of the investment thesis is anchored by the successful expansion of the Zgounder Silver Mine and the emerging world-class potential of the Boumadine Project. The company's strategic trajectory is defined by its ability to execute complex engineering projects. The company reported record-high quarterly revenues of $54.3 million in the third quarter of 2025, representing a five-fold increase over the previous year. This growth is not merely a function of market pricing, but is a direct result of a disciplined operational ramp-up that saw the Zgounder processing plant consistently outperform its design capacity. Furthermore, the corporation's presence in Morocco provides a unique jurisdictional advantage in American silver districts that have faced regulatory headwinds and social unrest. Morocco has positioned itself as a mining-friendly jurisdiction with a modernized legal framework and a strategic ambition to become a regional mineral hub. The company's first-mover status in this jurisdiction has allowed it to consolidate significant land packages along the prospective South Atlas Fault, several of which host past-producing mines and historical resources.
Operational at the Zgounder Silver Mine. The Zgounder Silver Mine serves as the primary cash flow engine for the corporation. Over the course of 2024 and 2025, the mine underwent a transformative expansion, increasing its milling capacity from approximately 700 tons per day to a steady state exceeding 3,000 tons per day. This expansion involved the integration of a new processing plant with existing flotation and cyanation circuits, a feat that management delivered on a capital-efficient basis. By the third quarter of 2025, the operation had reached a record throughput of 3,326 tons per day, running 23% above its original nameplate capacity. The metallurgical performance at Zgounder has been a standout feature of the ramp-up. Silver recoveries, which typically range in the mid-70% range for comparable global silver mines, reached an impressive 92.5% in the third quarter of 2025. This efficiency is attributed to optimized blending strategies, circuit improvements, and the successful commissioning of an oxygen plant that now operates near design capacity. The high recoveries are crucial because they directly enhance the company's ability to maximize its realized silver price per ounce sold, which reached $39.85 during the same period.
Mining operations at Zgounder are dual-faceted, combining underground development with open-pit extraction. The underground mine has reached a steady-state production of 1,300 tons per day, with grades averaging 159 grams per ton of silver. Concurrently, the open-pit operations have focused on stripping in the northeast section, yielding approximately 1,066 tons per day at a grade of 123 grams per ton. The open pit provides significant flexibility to the mine plan, and the company has invested in additional mobile equipment to lift open pit output above 2,000 tons per day by the first quarter of 2026. This will involve enhanced grade control and ore recovery through blast movement tracking and advanced modeling, ensuring that the higher-grade underground ore is appropriately blended with open pit material to maintain optimal mill performance.
Geological potential and reserve replacement at Zgounder. The longevity of the Zgounder mine is underpinned by a robust geological model and a successful track record of reserve replacement. As of late 2025, the corporation published an updated technical report that extended the mine life to 2036, based on a capital-efficient open-pit strategy complemented by targeted underground zones. The proven and probable reserves were estimated at 73 million ounces of silver at an average grade of 145 grams per ton, representing a 4% increase in silver ounces net of depletion. This growth is significant as it indicates a reserve replacement ratio of 120%, meaning the company is finding more silver through exploration than it is extracting through mining. The exploration strategy at Zgounder remains aggressive, with 20,000 to 25,000 meters of drilling planned for 2025 and 2026. Recent results have confirmed the continuity of mineralization beyond the current resource model, particularly at depth and near the granite contact. High-grade intercepts, such as 1,305 grams per ton of silver over 6 meters and 1,164 grams per ton over 3 meters, demonstrate the potential for further resource upgrades. Furthermore, the discovery of a new mineralized zone north of the current open pit highlights the regional potential of the Zgounder permits, which cover 452 square kilometers.
The corporation's ability to replenish reserves is bolstered by a deeper geological understanding gained through 275,000 meters of drilling conducted since 2021. This structural knowledge has improved the reliability of the mine plan and reduced dilution risks. Management remains focused on optimizing the Super Pit project and advancing underground development toward deeper levels, ensuring that Zgounder remains a low-cost, high-margin producer for the next decade. The updated mine plan estimates average annual silver production of 6 million ounces over the next 11 years, totaling approximately 66 million ounces over the life of the mine, with an average cash cost of $16.26 per ounce. The Boumadine Project, reshaping the corporate profile. While Zgounder provides the foundation, the Boumadine Project represents the next phase of the company's evolution. Located in Arachidea province in eastern Morocco, Boumadine is a polymetallic asset that the company owns 85% of. A preliminary economic assessment, PEA, released in November 2025 outlined a district-scale project with economics that are among the most attractive in the undeveloped precious metal space. The PEA envisions an 11-year mine life with an 8,000-ton-per-day operation, producing gold, silver, zinc, and lead.
The economic highlights of the Boumadine PEA are particularly robust when assessed at contemporary metal prices. At base case assumptions of $2,800 per ounce for gold and $30 per ounce for silver, the project generates a post-tax net present value at a 5% discount rate of $1.5 billion, with an internal rate of return of 47%. At spot prices, which in late 2025 saw gold at $4,000 and silver at $48, the post-tax NPV jumps to $3 billion, with an IRR of 77% and a payback period of only 1.2 years. These figures suggest that Boumadine is not just a secondary asset, but is a company maker that could eventually dwarf the production scale of Zgounder. Production targets for Boumadine are aggressive, aiming for an average annual output of 328,000 ounces of gold equivalent over the life of the mine, and 401,000 ounces during the first 5 years. On a silver equivalent basis, this corresponds to approximately 30.6 million ounces per year over the life of the mine, and 37.5 million ounces annually in years 1 to 5. The project plan involves 6 open pits and 3 underground mines, with a conventional flotation plant producing 3 payable concentrates. The low initial capital expenditure of $446 million, which includes a $96 million contingency, highlights the capital efficiency of the project.
Exploration upside and world-class scale at Boumadine. The current resource estimate for Boumadine, which supports the PEA, includes an indicated mineral resource of 5.2 million tons and an inferred mineral resource of 29.1 million tons. However, this estimate only incorporates drilling conducted up to February 2025 and excludes approximately 130,000 meters of drilling completed since that time. This implies that the current economic assessment likely represents a conservative baseline for the project's ultimate scale. Ongoing exploration at Boumadine has been exceptionally successful, with the company announcing its strongest mineralized intercept to date in November 2025. Hole Bou MP25-087 intercepted 2,323 grams per ton of silver equivalent over 15 meters, which included an exceptionally high-grade interval of 3,858 grams per ton of silver equivalent over 8.7 meters. This intercept, located in the southern portion of the main trend, sits outside the current PEA pit shells, suggesting that the ultimate pit sizes and resource volume are poised for significant expansion. In addition to the high-grade intercepts along the 5.4-kilometer main trend, the company has identified a new high-grade parallel structure in the southern portion of the project. Hole Bou DD25-623 intercepted 540 grams per ton of silver equivalent over 47.3 meters, including higher-grade subintervals. These large, continuous mineralized zones point to a district-scale system that remains open in all directions.
To capitalize on this, the company plans to increase its drill rig count between 12 and 16 in the first quarter of 2026, targeting a total of 360,000 meters of infill and exploration drilling over the next 2 years to advance toward a construction decision.
Financial performance and capital allocation strategy. The financial results reported by the corporation in late 2025 reflects its successful transition to a higher capacity producer. In the third quarter of 2025, revenue from silver sales totaled $54.3 million, a 393% increase year-over-year. This surge was driven by the commercial production of the new Zgounder plant and an average net realized silver price of $39.85 per ounce. For the first 9 months of 2025, cumulative revenue reached $126.8 million, more than tripling the revenue of the previous year. Profitability has also reached record levels, with net income of $12.4 million and diluted earnings per share of 9 cents reported for the third quarter of 2025. While this EPS figure slightly missed some analyst estimates of 10 cents, leading to a minor 2.3% decline in the stock price, the overall financial trajectory remains exceptionally strong. Operating cash flow for the quarter was $22.4 million, bringing the year-to-date total to $38.1 million. This cash generation is critical as it provides the internal funding necessary to advance the development stage Boumadine asset without excessive reliance on equity dilution. The corporation's balance sheet is characterized by high liquidity and a manageable debt profile. As of September 30, 2025, the company held an unrestricted cash balance of $129 million. Total debt was approximately $111 million, resulting in a debt-to-equity ratio of 28.2%. The company's debt is well covered by its operating cash flow, with a coverage ratio of 34.6%. Furthermore, interest coverage stands at 3 times EBIT, indicating a stable financial position. The corporation also maintains a flexible capital structure, having closed a $144 million Canadian bought deal financing earlier in 2025 to secure its long-term growth objectives.
The outlook for the company's cash flow generation is highly bullish, supported by both sustained production at Zgounder and the massive potential of the Boumadine Project. Analysts forecast that the company will grow its annual revenue by 26% and its earnings by 47.4% per annum over the next few years. Revenue is projected to climb from approximately $181 million in 2025 to $198 million in 2026, and reach $267 million by 2027. This growth is expected to drive EBITDA to approximately $179 million by 2027. A significant near-term booster for non-dilutive cash flow is the agreement to sell a legacy ore stockpile at the Boumadine Project. This stockpile, created during historical mining in the late 1980s, is estimated to contain roughly 2.5 million ounces of silver equivalent. Shipments are currently underway, and payment is expected by the end of 2025, providing a unique infusion of capital that will directly fund the advancement of the Boumadine feasibility studies. Additionally, the company's free cash flow yield is expected to reach 8.9% by 2026, assuming stabilized operations and the current silver price environment. Looking at the long-term project economics of the Boumadine asset, the potential for cash flow is transformative. Under the base case scenario, $2,800 per ounce gold and $30 per ounce silver, the project is expected to generate $1.96 billion in post-tax unlevered free cash flow over its 11-year mine life. At spot prices, $4,000 per ounce gold and $48 per ounce silver, this figure balloons to $3.82 billion, highlighting the massive operating leverage the company holds. This scale of cash generation would place the company among the top tier of precious metals producers globally, providing ample internal capital for further regional expansion and potential dividend distributions in the future.
Cost management and efficiency metrics. As the corporation scales its operations, managing all-in sustaining costs and cash costs remains a primary focus for the executive team. In the third quarter of 2025, cash costs per silver ounce sold at Zgounder were $20.79, representing an 11% decrease year-over-year and a 2% decline quarter-over-quarter. This reduction reflects the benefits of scale as production ramps up and the impact of more advanced mining sequences in the open pit and underground stopes. During the first half of 2025, costs were somewhat elevated due to early-stage open-pit stripping and underground development, as well as higher prices for cyanide. However, management has indicated that cost normalization is anticipated in the latter half of 2025 as throughput stabilizes and cyanide pricing eases. The current cost structure remains competitive, particularly given the high-grade nature of the deposit and the significant silver price rally that has expanded operating margins to over $30 per ounce in some periods. For the Boumadine Project, the preliminary economic assessment estimated life-of-mine cash costs of $928 per ounce of gold equivalent and an all-in sustaining cost of $1,021 per ounce of gold equivalent. These figures highlight the capital-efficient nature of the project and its ability to deliver industry-leading returns on invested capital. The corporation's primary focus for 2026 is the rationalization of costs across both major assets, while maintaining an aggressive exploration schedule that is budgeted between $25 and $30 million annually.
The geopolitical context of the corporation's assets in Morocco is a fundamental pillar of the investment case. Morocco has emerged as one of the most attractive mining jurisdictions in Africa, characterized by political stability, a modernized legal system, and a strategic intent to leverage its mineral wealth for industrial development. Under the leadership of King Mohammed VI, the country has implemented structural reforms to position itself at the epicenter of the global race for strategic minerals. Morocco's unique advantage is its status as the only African country with a free trade agreement with the United States, alongside its deep economic ties to the European Union. This has made Morocco a critical destination for large-scale investments in the refining of minerals such as cobalt, phosphate, and copper, which are essential for the production of electric vehicle batteries. The country is currently witnessing a surge in investment from Chinese companies seeking to utilize Morocco as a gateway to the U.S. market, navigating the complexities of the Inflation Reduction Act. For the company, this environment translates into low geopolitical risk and strong government support. The Moroccan Ministry of Energy Transition and Sustainable Development has prioritized the digitalization of the mining cadastre and the formalization of small-scale mining to enhance sector transparency and efficiency. The company's assets are located along the South Atlas Fault, a region with a long history of mining and a deep talent pool of local geological and operational expertise. The presence of major international lenders such as the European Bank for Reconstruction and Development in the company's debt syndicate further validates the jurisdictional stability and the quality of the company's environmental and social practices.
Valuation analysis. Valuation sensitivity for the company is highly geared toward the Boumadine Project's success and spot metal prices. The 2025 Preliminary Economic Assessment (PEA) for Boumadine reveals a staggering net present value (NPV) of $3 billion at spot prices, which translates to a project roughly 6 times the scale of Zgounder's current silver equivalent output. This massive resource expansion has yet to be fully factored into the current market capitalization of $2.8 billion, providing what many analysts describe as a re-rating narrative built on the project's transition toward a Tier 1 asset. For the corporation as a whole, the price to net asset value (P to NAV) multiple currently sits at 0.7 times, representing a discount to the 1 times NAV often applied to established producers in supportive jurisdictions. Technically, the corporation trades on a price-to-sales (P to S) ratio of 15.2 times, which is significantly higher than the Canadian metals and mining industry average of 7.4 times. While this may appear expensive on a trailing basis, it reflects the market's willingness to pay a premium for the company's exceptional growth profile. Analysts project earnings per share to grow by 68% per annum, reaching 90 cents per share by 2027, which would dramatically compress forward valuation multiples as the Zgounder plant reaches peak efficiency and Boumadine moves closer to construction.
When benchmarked against its global and regional peers, the company exhibits a unique blend of high-growth premiums and deep-value asset discounts. In the high-grade silver space, the company's price-to-sales ratio of 15.2 times places it in the upper echelon of its peer group, alongside London Gold at 13.2 times and Artemis Gold at 15.2 times. This premium is justified by the company's status as the only TSX-listed pure-play silver miner, avoiding this silver-equivalent dilution common in polymetallic peers. In contrast, established mid-tier producers like Pan American Silver and First Majestic Silver trade at much lower forward PS multiples of 4.38 times and 4.48 times, respectively. However, these companies lack the concentrated organic growth profile that the Morocco-based assets offer. For instance, while First Majestic carries a high PE ratio of over 115 times, Its production growth is largely acquisition-driven, such as the Gato Silver deal, whereas this corporation is expanding through direct engineering and exploration success at its own existing projects. On a P/NAV basis, the company remains highly attractive compared to other developers. While advanced-stage silver developers typically average between 0.76 and 0.88 times P/NAV, this corporation's 0.7 times multiple indicates that the market is still cautiously pricing the technical risks associated with the Boumadine build and the regional political environment. Competitors such as Vizsla Silver have shown that high-grade feasibility projects can command IRRs of over 100%, a benchmark that the company's Boumadine project matches at spot prices, with a 77% post-tax IRR. This suggests that as the project reaches its full feasibility stage in 2027, a significant valuation catch-up is likely, as the corporation is re-rated from a single mine producer to a multi-asset major.
The corporation has a clear roadmap for the next 4 years, with several key catalysts that could drive a significant re-rating of its valuation. For 2026, the primary focus will be the execution of the 360,000-meter drilling program at Boumadine and the optimization of the Zgounder mill to its sustainable peak capacity. Investors will be closely watching for resource updates at Boumadine, which are expected to incorporate the high-grade drilling results received throughout late 2025. In 2027, the company intends to enter the full feasibility stage for Boumadine and begin detailed engineering. A construction decision is targeted for the end of 2027, with building activities expected to span approximately 2 years. This timeline would see Boumadine coming online in 2029, a period when many analysts expect the silver market to remain in a structural deficit. Concurrently, the company will continue to explore its regional permits in Morocco, including the Zgounder Far East and Torchcal permits, which offer the potential for further satellite discoveries. Operational milestones at Zgounder will also serve as catalysts, particularly as the mine accesses more continuous high-grade mineralized zones in the underground stopes and the northeast open pit. The delivery of targeted improvements to the mine plan, focusing on grade control and dilution minimization, will be critical for maintaining the company's high recovery rates and low cash costs. With over 150,000 tons of stockpiled ore available, the mine is well positioned to deliver strong production results in the near term.
Risk analysis: navigating the complexities of growth. Despite the robust growth profile, investors must account for several multifaceted risk factors that could impact the company's trajectory. These risks range from localized geopolitical tensions to environmental constraints and technical uncertainties in the development of the Boumadine asset. Geopolitical border tensions and regional stability. The Boumadine project is located in Arashidia province, approximately 220 kilometers east of Ouarzazate, positioning it near the sensitive border with Algeria. Relations between Morocco and Algeria have been historically strained, with the land border sealed since 1994 and diplomatic ties formally severed in August 2021. In 2025, tensions escalated further following planned Franco-Moroccan military maneuvers, Chergui 2025, in the Arashidia region, which Algeria termed a provocation. While Morocco is generally considered a stable and mining-friendly jurisdiction, any significant escalation in border hostilities could disrupt logistical routes or impact the regional security environment for the Boumadine project.
Structural water scarcity and climate vulnerability. Morocco is entering a highly sensitive climate period, with recent data showing a sharp decline in renewable water resources. The Dra Tafalalet region, where Boumadine is located, is particularly vulnerable to structural water deficits and overexploitation of deep water aquifers. Persistent droughts and high temperatures have led to widespread thirst protests in nearby provinces like Zagora. For mining operations, which are water-intensive, this represents an operational risk and a potential source of community conflict. While the company has implemented water conservation measures and recycling protocols, the lack of groundwater renewal in the region poses a long-term sustainability risk for large-scale milling operations at Boumadine. Technical and metallurgical complexity at Boumadine. The Boumadine asset is a complex polymetallic deposit characterized by massive sulfide veins containing pyrite, sphalerite, galena, and chalcopyrite.
The Preliminary Economic Assessment, PEA, relies on a conventional flotation circuit producing 3 payable concentrates, but the project has an inherent level of metallurgical risk due to the refractory nature of some ores, where gold and silver are encapsulated within sulfide matrices. Furthermore, the current PEA is underpinned by a high proportion of inferred mineral resources, 29.1 million tons, which carry a lower level of geological confidence than indicated resources. There is no certainty that these inferred resources will be converted into proven reserves, and any failure to upgrade the resource through the planned 360,000-meter drilling program would materially impact the project's long-term economics.
Financial and market sensitivity. The company's valuation remains highly sensitive to commodity price volatility. Sensitivity analysis indicates that every 10% movement in silver prices can change the project's price target by 30%. While the company is currently benefiting from record silver prices, a sharp correction, potentially triggered by reduced industrial demand or shifts in U.S. monetary policy, could quickly puncture bullish assumptions and compress valuation multiples. Additionally, while the company has achieved record revenue, its earnings per share, EPS, missed forecasts in the third quarter of 2025, highlighting the ongoing challenge of managing costs amidst large-scale operational expansions. Conclusion: a Tier 1 growth asset in the precious metal space. The investment analysis of Aya Gold and Silver Inc. reveals a company that has navigated the high-risk transition from explorer to established producer. Its operational success at Zgounder, characterized by throughput and recoveries that exceed original expectations, provides a robust financial foundation and a track record of execution. The company's focus on high-grade assets in a supportive jurisdiction like Morocco provides a significant competitive advantage in a sector where high-quality silver exposure is increasingly rare. The Boumadine Project represents a growth catalyst. Its economic projections, characterized by low capital intensity, rapid payback, and massive production scale, suggest that the company is on a path to becoming a dominant player in the global silver and gold markets. When combined with a bullish macroeconomic outlook for silver, driven by the metal's critical role in the global energy transition, the corporation's strategic positioning appears highly favorable.